Hey everybody, Smart Silver Stacker here. Hope you're doing well. Welcome to another live stream. Today we're going to talk about the sentiment surrounding both gold and silver, because I don't know about you, but to me, when an asset is in the toilet in terms of sentiment, and when everybody else is selling, few other people are buying, I think that personally is a great time to accumulate that asset. Now, first of all, I do just want to say that none of this is financial advice. I'm not telling anybody what to do with their money, but from my point of view, it's hard to say that the sentiment for gold and silver is anything other than abysmal at the moment. You can see here on the long-term chart of silver that silver is down to around $22.58 as we're recording this video, less than half of its 2011 high. And there are a number of factors that we can examine here that just go to show how unloved silver and gold as well, but more so silver, just how unloved these assets are at the moment. First of all, let's take a look at this gold to silver ratio. It's a chart we've examined many times before, but it is worth examining again. And what this chart tells us, I want to talk about the dynamic driving the gold to silver ratio here. What this is the price of gold divided by the price of silver, basically. So how many ounces of silver does it take to buy an ounce of gold? And between the gold and silver markets, what you have to understand about them is the gold market and all of its paper derivatives compared to the silver market and all of its paper derivatives, gold market's about 10 times bigger. It's a much more liquid environment. It is much safer by many people's standards than the silver market. And so when you have sentiment towards the precious metals at a low, investors tend to lean towards gold because it is viewed correctly as the safer environment and the more stable store of value, which all of that is very true. And then the flip side of that is that when sentiment for the metals gets very bullish, the investor sentiment towards silver changes in a big way, because rather than looking for that safe store of value, they're looking for the metal that's going to move and provide them with the biggest returns. And you can see that on this chart right now. We are above 85, which is very high from a historical standpoint. And yet in the past 50 years, we've had two major bull markets in the precious metals market. In 2011, when this ratio was driven down to just below 35, and then also in 1980, when it dipped as low as 15, around there. That was, of course, when gold and silver were spiking. A lot of people are going to say this artificially low ratio here, what people will claim is artificially low, is due to the Hunt brothers. But regardless, you see the same dynamic in 2011, the ratio dropping far below where it is today. And at the same time, you can see in 2020, when we got this ridiculous spike above 110, that was when nobody wanted the metals. Everybody was selling. Silver sold off down to $12 or something like that. Huge sell-off. And that, of course, was a great time to buy when the ratio was spiking up, because silver ran from about 12 or 13 bucks to about 29 in 2021. But anyway, this shows us that investors right now are not very excited about the precious metals. We don't just have to look at the gold to silver chart. We can also look at premiums on physical metals. So here's a gold eagle from SD Bullion going for any quantity, by the way. It's on sale, $2,131 with the spot price around $2,039. So it's about a 4.5% markup. This is much lower than the premiums we were seeing a little less than a year ago, back in March of 2023. Everybody was trying to get into physical precious metals at that time. Premiums on silver eagles like this one skyrocketed to almost 100% over spot. Now, $3.99 over spot. You can get a silver eagle right now for $26.74. Any quantity pricing. Again, this shows when you see these U.S. mint products, the premiums coming down on them. SD Bullion's running sales on them. They're becoming more available, more obtainable. It's not because all of a sudden the mint just released a huge number of coins. It's because there's less demand for the metals right now. And again, the reason you want to snap up assets, if you ask me, when they're on sale, when they're unloved, is because once everybody sells Well, there's nobody left to sell. I mean, from there, you've hit a market bottom. You would expect to see sentiment, being absolutely terrible near a market bottom. Whereas in a bull market, when everybody gets excited, it's when, you start hearing people talk about silver in the mainstream. That's when you want to be worried and, think about maybe it's time to sell. This is another chart. This is the Dow to gold ratio, 100-year historical chart. So we're going to talk about gold here a little bit, but this is basically the relative valuation of gold to paper assets. And you can see that twice in the past 100 years, this ratio has collapsed very low. In 1933, because the price of stocks were collapsing during the Great Depression. Of course, gold was at a fixed price back then because it was backing the dollar. And also in 1980, that was as the price of gold spiked up. So, two different causes here. But what we can see here is that this chart tends to oscillate. And right now, at a ratio of around 18, we are at the high end of the relative valuation of gold to stocks. And you don't have to even really look at a chart to understand this. Just go watch mainstream media. All you hear about are tech stocks, cryptocurrencies, broad stock market. I mean, very few voices are talking about gold. And also, nobody is talking about silver. Let me know if in the chat, if you've heard anybody talking about silver in the mainstream media, or if anybody that you know outside of the stacking community knows anything about silver. How many people know about Bitcoin? They're running ads for it constantly. They talk about it constantly. The story about the Bitcoin ETFs, that was huge news. Nobody is talking about precious metals. So, the sentiment for metals can't get much worse. And I think that this is a dynamic ultimately that's going to change, and we're going to get into some of the bull case for the metals here towards the end of this video. But right now, nobody is talking about these things. Sentiment is absolutely in the toilet for these, and you can kind of see this too when you look at the miners. So first, I just want to take a look at the chart of gold here. This is a very nice looking chart, if you ask me, despite the fact that very few people seem interested in getting into the gold market right now. The price of gold is near record all-time highs. It's towards the breakout point of this large cup and handle formation that is forming on its long-term chart. So, the chart for gold looking really good, and yet still nobody seems to be too interested in it. Now, this is the chart for Newmont Mining, the world's biggest gold mining company, and I want to draw your attention to this spike up here that we had in April of 2022. So, at that time, the price of a share of Newmont Mining got to around $86. But today, look, we're at $34. Now, I want to look at this chart here, which compares in gold here. And I have this starting right at that peak in April of 2022. This is the gold performance of the metal itself here on this orange line, which you can see is actually up 2.79%. And yet the price of Newmont Mining down almost 60%. Now, what does that tell us? Well, you might say gold is a much safer bet than miners. That's 100% true. Gold is certainly much safer than the miners. But what you can tell here is that investors must anticipate that the price of gold is going to be lower in the future, or at least not move up. And part of why the stock has performed not as well as the metal is because of inflation, because of higher costs, because of higher labor costs, energy costs, transport costs for these companies, whereas the metal that they're selling is only up 2%, can't make up for all of that inflation, but also because of investor perceptions of where the price of gold is going next. So, this is another indicator that we can look at just to tell us how poorly perceived the metals and their derivative assets are right now. And again, I think that to me as a contrarian looking at things, that's kind of a great sign that now is a good time to be accumulating these things. Now, I want to take a look at this. This is from silverprices.us, and it's a list of historical silver prices going back to 1970. And 1970 is a good place to start because 1971 is when Richard Nixon ended the convertibility of the dollar into gold. And so that kind of is when the dollar went into its current fiat form. Now, I want to take a look at some previous bull markets here in silver and see how the data looks. In fact, I'm going to pull up a calculator here. So Put a 1 in the chat if you can see the calculator on your screen, because I want to make sure you can. But let's go ahead and take a look at some of these numbers. So you've got 1971. Again, that's the year that Nixon took us off of the gold standard. The average silver price, so that's what this column that I have highlighted here is, your average silver price, and that's what we're going to be talking about, was $1.54. Now the bull run went to, in 1980, an average price in 1980 of $20.98. Okay, so we're not talking about the big blow off top with the Hunt brothers. We're talking about the average price for the entire year. And yeah, sure, the Hunt brothers thing does add to that average, but let's just take a look at what kind of a gain that is. So that's an average price of $20.98 in 1970, 10 years before, $1.54. So that's about 13.6 x return on buying silver for 1971, just on average, stacking, dollar cost averaging, to selling in 1980. Now, let's take a look at more recent activity, more recent bull markets. 2001, the price of silver bottomed out with an average price of $4.37. In 2011, average price $35.12. So that is not quite as significant a return over 10 years. However, it is an 8-fold return, so not bad. And, you know, one of the interesting things about these previous bull runs in silver that I want to draw your attention to is that the vast majority of the gains get put on right at the end. So sure, from 2001 to 2011, pretty good years here. I mean, in 2006, a 46% increase, but the biggest years were 2009 with a 57% increase, and 2010 with a 80% increase from open to close of the year. And so you can see the majority of the gains being put on towards the end of the 10-year bull run. And it was the same story from 1971 to 1980. You can see, yeah, you got some pretty good years here, up 60% in 1973. But look at that. I mean, in 1979, before the blow-off peak with the Hunt brothers, that was in 1980, you went from $5.94 to $32.20 in 1979. So the vast majority of the gains coming right at the end. Now, let's extrapolate here just for fun. You might be waiting to hear what the numbers imply. And, you know, of course, history doesn't repeat. Sometimes it rhymes. In 1979 and 1980, you know, it just wasn't just the Hunt brothers that were driving the price of the precious metals higher. There was also a lot of geopolitical instability. Afghanistan had been invaded by the Soviets. Inflation was high. The Fed was actually cranking up interest rates. Paul Volcker became Fed chair at the end of 1979 and started cranking up the federal funds rate then, which you should note he was cranking up rates before gold and silver peaked. So, you know, there's a lot of similarities between then and now, actually. But if we were to say just take the same performance that we saw from 2001 to 2011, no Hunt brothers involved, if we look at 2015, that would be the bottom here for the price of silver at $15.66. So if you multiply that eightfold, like what we saw from 2001 to 2011, you get a silver price in 2025 of $125.28. Now, I mean, this is just playing around with numbers. There's no guarantee that that's going to happen. Nobody can time these markets. You know, I don't have a crystal ball, but I think it goes to show you just how cheap silver is, considering the fact that we do seem to be in a bull market for the precious metals, in the sense that gold just hit a record all-time high, and it really hasn't corrected back too much yet. And yet silver has barely moved. I mean, it's done very little. It's done almost nothing. It's so cheap, you know. So I'm happy to continue stacking that. And also, I want to get into the bull case for the metals here too, because while it does appear that investors at large are completely disregarding the precious metals, one class of investors that is not are central banks. They are loading up on gold right now. So, you know, maybe premiums have come down on gold coins. Maybe gold miners are in the dumps, and investors at large think that the price of gold is going to be much lower moving forward. But central banks are buying gold at an absolute record pace. In fact, you can look at this chart here from the World Gold Council. The dark green over that center line represents purchases. The lighter color green below the line is sales, and you can see the pink is net. So anytime this pink line is above this middle line here, that means they are net accumulating metals. And when you add this up for the whole year, they are accumulating a huge amount of gold. And this spike down that we saw, this really just had to do with some weird stuff from Turkey and their inflation being forced to sell gold. They're actually back in the mix, loading up even at a faster pace now, according to this most recent data. Now, this is from October, and I would imagine that as we have moved forward, central banks still are loading up on gold. Thank you so much, Jeff Tooley Tiger Thomas, in the chat there, who has gifted some memberships, and that's awesome for everybody who got one of those. Thank you so much, and I do appreciate everybody who supports this channel. And do me a favor, I'll just take a break real quick. Please like the video. It helps get this information out there. It's very helpful for YouTube. YouTube isn't really particularly keen on spreading information about precious metals. They also seem to have a low opinion. But you can see some of the countries here. This is kind of small print, but China, Poland, Singapore, Libya, India, Czech Republic, Qatar, Philippines. These are some of the countries, Iraq, who are absolutely loading up on gold. And let's talk about why. Why are these central banks loading up on gold? Well, there's a global trend towards de-dollarization right now. And, when you de-dollarize, what do you go to? I mean, you get some yuan, sure, you can get some local currencies, but gold is kind of the obvious option to de-dollarize into. This is a report from the Wall Street Journal from December 28th. This is very interesting. Natasha Koneva, head of global commodity strategy at JP Morgan Chase, said this: the US dollar is getting some competition in commodities markets. She estimates that the proportion of the world's oil that is bought and sold in other currencies has risen to about 20%. So to understand the magnitude of this, you've got to understand another dynamic which has been in effect since the 1970s. 1971, Nixon took us off of the gold standard. Well, in 1974, he and Kissinger came up with this idea to create the petrodollar. So we give military support to Saudi Arabia. We become their ally. They're the biggest exporter in OPEC. They denominate all of their oil sales in dollars. So does everybody else, kind of following the leader. That's really good for the US dollar. Well, now, with the rise of the BRICS nations, this dynamic is coming under a huge threat. And as this occurs, as countries around the world begin to dump the dollar for settling international payments, there is the need for an alternative. And I think gold is what central banks are looking at. There really is no other fiat currency that will satisfy the needs that these nations have for settling payments. And that's why the only alternative to the dollar is going to be gold. And yeah, I see some folks talking about Basel III and how gold has been returned to its denomination as a tier 1 asset. It's 100% valued for the purposes of banking viability. Interesting that that has changed, but that is also part of why the banks are loading up on gold, and it has returned to being what they call a tier 1 asset. Thank you for that, Eric Wild, who put that in the chat. Now, I want to talk about this real quick. Saudi Arabia, a couple days ago, they said they're still considering BRICS membership, and as far as I know, this is the latest update. I looked, I couldn't find anything more recent, but at Davos, they tell us that they're still considering this invitation to join BRICS. Now, some people might think that this means the petrodollar is perhaps safe, that the Saudis are not thinking of joining BRICS. They might be reconsidering that, turning it down just like Argentina did. To me, I think that this is actually a sign that perhaps the Saudis joining BRICS hasn't been fully priced into the markets yet, because it hasn't actually happened yet. They were invited, but they have not themselves joined yet. And when they do, I suspect that this may be coinciding with some significant moves towards de-dollarization, towards the end of the petrodollar. And this may be, with a bunch of U.S. aircraft carriers surrounding them at the moment and in the midst of a large Middle Eastern conflict, maybe why they are kind of holding off on this. They don't want to rock the boat. In the past, when countries have de-dollarized and, abandoned the dollar for settling oil payments, it hasn't really worked out that well for them. You can ask Saddam Hussein about that, or Muammar Gaddafi. So I kind of understand why they're hesitating here. However, when they actually do join BRICS, if they do, that could be a moment of significant devaluation for the dollar, as it becomes clear that that is the way that they are going to move. And also, you've got Russia and Iran. This is a story from last year, but in this context, it's important to revisit. Russia and Iran reported last year that their central banks were working together to create a gold-backed stablecoin for foreign trade settlements to replace the dollar, ruble, and Iranian rial. So, this also could have something to do with why we're on the verge of war with Iran. As I said, Saddam Hussein, he de-dollarized. He tried to denominate Iraqi oil sales in euros, and he was, taken out as a result of that. A war was waged as a result of that. At least that's one take on that conflict. And the information about Muammar Gaddafi, the theory is that he was preparing a gold-backed dinar currency for settling Libyan oil payments and for settling payments between African countries. That's a little bit harder to verify, although I do think there's something to that, and there is a reason that the military-industrial complex was turned on Gaddafi and why he was deposed. But the point is that this time, Iran actually did join BRICS. They're a member. Russia and China also members, the countries with some of the largest nuclear arsenals on the planet. So it's not quite the same thing as Iraq or Libya in this case. And I think this time there may be actually a real possibility of a move towards gold as a means of settling payments, regardless of whether we get a war as a result or not. Now, also, I want to talk about the dynamic driving the price of gold and silver right now, because, the fundamentals for gold and silver are pretty good, but why is sentiment so low? There is a reason that nobody wants gold and silver right now, and it's because the whole free market mechanism of setting prices has essentially gone out the window at this point. It doesn't exist anymore. And we had, sure, there might be some manipulation. We know there's manipulation in the precious metals. That's why JP Morgan has paid over $1 billion in fines. That's why some of their traders were convicted of spoofing gold and silver. But up until 2008, supply and demand played a bigger role in these markets than it does today. And since then, the Fed just printing all of this easy money, getting the markets addicted, bailing everybody out, getting them addicted to low interest rates and 0% interest rates. Interest rates were kept for years near 0%. So all of the regular supply and demand fundamentals are out the window. And the only thing that matters anymore is what the Federal Reserve is going to do next. That's part of why we are seeing a significant decline in sentiment towards the metals right now, because the propensity of the Federal Reserve, or the way that markets anticipate the Federal Reserve is going to behave here, the odds of rate cuts are declining. And it's because the Fed has been talking down the possibility of rate cuts. You had Fed Governor Waller coming out the other day telling us that maybe we can get them as long as inflation doesn't tick up. Of course, inflation was ticking up in December. They have these phony numbers that say, oh, the economy's strong. Retail sales are up for December. Of course, the reason retail sales are up is because everything's so much more expensive. They're not inflation-adjusted numbers. And so, it's not like we have a super strong economy. We just have a bunch of people buying groceries for, twice what they were a couple years ago on their credit card. That's not a sign of a strong economy. But we got those numbers and you saw these odds shift and you saw the price of gold and silver come down. So, the narrative here is that the economy is really strong. Inflation is maybe still a little bit elevated, but the Fed is, thinking of fighting it. The reality is we have a house of cards economy. The Fed is going to be forced to cut because it's an election year and people are broke, and we're going to see a massive economic collapse if they don't cut. But you can see now markets are anticipating it's not going to be until May until that we get rate cuts. Now, I don't know when the Fed is going to cut rates. It just depends, right? It's like, how soon is the economy going to collapse as a result of all of the massive debt? You've got the commercial real estate sector on the verge of collapse. You've got any number of sectors, insolvent regional banks. We've got huge numbers of emergency loans going out of the Fed's Bank Term Funding Program every week for the past 2 months. It's been hitting a new record high. And yet, what's really driving gold and silver here is just that people believe the words coming out of the mouths of central bankers telling us that they might not cut. I mean, they're going to have to cut. But to the extent that the price of gold and silver go down because a banker, runs his mouth, I mean, this is a big buying opportunity, if you ask me, because nothing fundamentally has changed. Keep in mind, this is the most recent monthly Treasury statement, which reveals that in the first quarter of fiscal year 2024, we had a $510 billion deficit. We've got a $34 trillion national debt. I mean, look, we're about to go to war. World War III is already underway. It's going to be very expensive. Who's going to pay for it? The BRICS nations, they're not going to buy our treasuries. Saudi Arabia is not going to load up. They're probably not going to have a lot of dollars coming in because they're not going to be taking petrodollars anymore. So, who's going to buy all this debt? The Federal Reserve that's who's going to buy it. I mean, that's the bottom line. It's the only way. I mean, we either default on the debt or the Fed buys it, because if they let interest rates skyrocket as all of this new debt is issued, the banking sector will collapse. I mean, all these financial institutions are sitting on piles of low-yielding U.S. treasuries. Every time the yield on them, which, by the way, the yield has been moving up once again, every time it goes up, they lose money. They have unrealized losses. Eventually, depositors are going to pull their money out of those accounts, force the financial institutions to sell those treasuries at a loss. Could create a massive financial crisis, just like what we saw in March. But they're not going to let that happen. They're going to print the money. I mean, I think we know that. They've shown their hand. In March, they bailed out the banks, the FDIC. I was talking recently on a recent podcast about how banks' earnings are coming under some pressure right now. One of the reasons that the bank's earnings are coming under pressure, I didn't mention this on this live stream, on that live stream, I meant to, but it was because they just had to pay a big one-time fee to the FDIC because of the bailouts that the FDIC had to make depositors in those failed banks whole. So, I mean, that money's got to come from somewhere. And ultimately, if we see more bank failures, it's going to be more pressure on the banks. I mean, the whole system is insolvent. And the bottom line is, we don't have a dollar backed up by gold anymore. It's backed up sort of by oil sales, but really what we have is a fiat currency which is entirely dependent on an ever-expanding debt. And the only way that you can expand the debt endlessly is if the central bank comes in and functions as the buyer and lender of last resort, expands their balance sheet. I mean, they're already talking now, JP Morgan, about the Fed ending QT sometime in 2024. Well, they've only got their balance sheet down to $7.7 trillion. They haven't even put a dent in their balance sheet yet, and they're done. Well, it's only a matter of time until they start buying again. I mean, do you really think they're going to let the financial system just collapse without intervening? Of course they're going to intervene. But nobody understands this, or at least people don't seem to be worried about the right things. I mean, everybody's chasing the latest tech stock, the latest cryptocurrency, the latest ETF. They're not focused on the real problems here. And the bottom line is that things that aren't sustainable will not be sustained. And I don't know how long this game of musical chairs can go on, but when it stops, I think a lot of people are going to be left without a seat. And that is when you'll see the sentiment towards gold and silver change in a big way. But until that happens, I mean, we're pretty lucky to be able to stack gold and silver at these prices. And look, I mean, if you don't agree with this, that's fine. I know even in the stacking community, sentiment right now is pretty low. But again, that's what you would expect near a bottom before a big move up. So none of this is financial advice. Keep that in mind. I'm not telling anybody what to do. I'm just telling you how I see things. But let me know what you think in the comments down below. I do appreciate everybody who tunes into these live streams. Share them. Get this information out there, because it's going to be important to have real assets when this all plays out. So thanks for watching, everybody. Stay safe and happy stacking, and I will catch you next time. Smart Silver Stacker, out.